So here we're going to turn our eye to Europe, and you're starting to get some of the concern out of Lagarde in terms of where inflation is. Now they're waking up to how bad inflation is becoming, and some of the things that are going to, they talked about addressing the policy in March. So next month they're really going to start looking at what is the policy change, how are they going to change it. And because of the commentary, which came out much more hawkish than what people were assuming, it's pulled forward the expectations of a rate hike into the end of 2023, which is obviously different from the earlier expectations where it wasn't going to happen. I'm sorry, the end of 2022 instead of the beginning of 23. So those are going to be some key pieces, and I think this chart shows just a summary of why. So economic confidence starting to roll over a bit. Things are softening, still elevated, but you're starting to see again some of these pressure points as the confidence is waning, as inflation continues to accelerate. GDP came in right in line with expectations, which is pretty much around what we were assuming. Eurozone manufacturing PMI was expected at 59, came in at 58.7. Again, we said it was going to be elevated. We thought there was going to be a bit more pressure on the services side, which we'll talk about in a minute. While CPI surged, the expectation was to be 4.4%, came in at 5.1% instead. Month over month was expected to be negative 0.4%, came in at a positive 0.3%. So again, big increases, with core CPI expecting to be at 1.9%, instead came in at 2.3%. All of these things are showing just where the pressure is, why inflation is becoming a bigger problem. And because wages didn't move in Europe the same way they moved in the US, because there isn't the same type of move, the inflation moving at this rate is going to have a bigger impact and is going to impact prices just even more. On the Euro service side, for PMI, we were expecting that big drop and then kind of flatlining. Here, the expectation was for 51.2, came in at 51.1. So the composite came in right in line with expectations at 52.3. PPI, again, surging to that high again. Expectations for 2.8, came in at 2.9. All of the things that we keep talking about are huge problems as we continue to move through the system. Excuse me. And then as the ECB announced today, rates are unchanged versus the expectations in the prior, but we could start to see some of these adjustments as we go into March. I don't think some of these are going to be huge shifts, but it's just what are the expectations going to be, or when are they going to start raising rates? And as long as inflation is moving at that clip, you're going to see them continue to try to take some action to offset it. Now, when you look at wage growth, this is, I think, the important piece. Still very low growth in wages, with inflation hurting consumption. So the ECB raising rates in 2022. This could be something where, based on low growth in wages, but with inflation where it is, it's going to be difficult not to raise rates. I know some people are saying that wages are still too low. You're going to have to see wages increase. But as inflation continues to go higher, where are wages going to go? And we do think that wage growth is going to increase. We don't think it's going to increase at the same rate as it did in the US, which is a problem because in the US, we can't keep up with the pace of inflation. So that just is going to make it that much worse in Europe, to give you an idea of where some of the different shifts are in the negotiated wage spot. So German negotiated wages are unlikely to pick up in the early stages of 22, given the timing of negotiations. But preliminary wage data for January 22 shows no improvement. But when you look at this, is again some of the different pieces on the negotiated wages. So the quarterly ECB series negative, unweighted country average for Germany. You can see it's just kind of for the data in the key EU nations, and then Germany ex bonuses is actually negative and falling and at a point where it was in 2011. So when you think about 2011 and the European debt crisis, you're getting an idea of the pressure that they're under and how is that going to shift, which is why we remain concerned on GDP and growth. Because without wage increases, as inflation goes parabolic up and wages are flat to down, that just exasperates the issue on the living wage side and is going to slow down consumption in general, putting additional pressure on services as we go into February. Now, when we look at the difference between euro area flash estimates and consensus forecast, largest upside surprise in the history of the euro area flash HICP inflation release, just to give you an idea of just how inflation continues to shift higher. And what are the biggest drivers? It's obviously energy, which when you turn to Russia, when you turn to some of the policies that they've made on trying to shut down nuclear, trying to shut down coal and natural gas, you're creating a lot of this negative feedback loop, which I think is going to be a much bigger discussion that or is going to have to happen as we go through the next decade, really. When we look at GDP Q3 into Q4, you're getting an idea of, again, some of that slowdown when you're looking at Q3, Q4. Not surprising in terms of where expectations are, and we're going to go through each one of them in its own piece. So on a positive side, credit impulse turned positive in Q4 for the first time in a year, thanks to the corporates, while household credit impulses contracted for the first time since Q1 of 21, as suggested by the ECB data, showing a net increase in loan demand in Q4. So when you look at the credit impulse by cluster, you get an idea of where some of the pressure resides and where some of the benefits are. So when you look at just the Eurozone private sector impulse, it's still positive, but again, it's just when you look at how positive, you get an idea of just where some of the pressure is going to be. As the periphery countries continue to struggle a bit, core countries, again, all of these Eurozone private sector impulses, you're getting this kind of convergence right here, which some positive, some negative. But then when you look at the Eurozone credit impulse by country, Greece negative, Italy starting to get a little bit better, but now you're having the spread widen following the ECB commentary. Portugal, France, and then when you get to the Eurozone on average at that 0.4, then when you look at credit impulse by country, you have Germany getting a bit better, Netherlands, but Germany is a good one because as that gets a bit better, that'll help kind of stabilize some of the things. As we've been saying, France is going to, France and Italy are going to be some of the bright spots when we look at the holistic numbers. But then when you look at, borrowing and investment, Germany being where it is going to provide some of that uplift from the bottom, both of which being nice tailwinds to try to offset some of the headwinds that we're seeing on the wages and on the consumption front. So then when you look at the Eurozone investment is weak, there's some of the different pieces that we're looking at in general. So real gross fixed capital formation across the G10 index to 100 in Q4 of 19. So you're seeing some of the pressure coming down where when you look at the U.S., we're flatlining. Canada's coming under pressure. The G10 median is back negative as the Eurozone, again, is still bumping along that bottom. But we do see some of that increasing over the next month, which will be, the next quarter, which will be that net positive, while other areas continue to weaken and likely to go negative, especially when you look at Canada and in the U.S. Now, when you look at the Eurozone economic sentiment, you can see that as rolling over and starting to get a bit worse. And then when you look at the Eurozone loan to business, that's increasing year over year as loans to households starting to curl, but fairly flattish. We just look into January and we see that loans to households have diminished again, while loans to businesses continue to grow in terms of where we see things going over that time period. Now, when we look at energy input as of industrial output, you get an idea of just how important energy is. And with energy prices where they are, it's not only a negative for businesses, but how does that get passed on to? It's a negative for the consumer. So the consumer is going to get hit at how they consume at home, but also they're going to face higher prices due to the increases that are coming through as corporations try to pass on this cost. Then when we turn and look at household energy prices, you get an idea of just how absurd it is. I'm not laughing because it's funny, because it's not, but just the absurdity of these moves is just awe-inspiring when you look at just how much damage it's doing to the local consumer, and especially as we continue through Q1. Now, when we turn to Germany, consumer confidence slightly better, expected at -8, came in at -6.7. Import price index came in lower than expected. That's starting to actually increase again. So that will go, the rate of change is going to increase, but again, still remain below where it was in November at 3%. GDP came in a bit more negative than expectations. Was expected to be negative 0.3%, came in at negative 0.7%. That we do see that bouncing a bit just because we are going to have an increase in activity on the construction side, manufacturing side, which will be a net positive. But CPI continues to surge. It was expected at 4.4%, came in at 4.9%. Month over month was expected at negative 0.2, came in at 0.4. Again, all shifting higher, which is putting pressure on the consumer. Retail sales came in at negative, was expected at negative 1.4%, came in at negative 5.5%, bringing retail sales year over year flat. We do see that changing. We have seen some acceleration, but again, still coming from a negative number, it's just going to be a bit less negative. Still not a great bounce. Then when you look at German manufacturing, expectations of 60.5 came in at 59.8. Still, positive. Again, one of the reasons why we do see some bounce in the GDP. Services expected right in line with expectations of 52.2. We don't see that changing. But German composite expected at 54.3, came in at 53.8. Again, positive. Still will provide some of that bump in Q1. Putting it into perspective, when you look at it quarter over quarter, some of that slowdown, we do expect to see that go positive. And then when you compare it to 2015, essentially just going sideways at this point, and something we do see, again, that rally, as we talked about last week, looking at GFK, looking at the some of the leading indicators where we will see some of that bounce in growth. German consumer spending plunged in Q4, but again, we are seeing some of that come back a bit. But just to give you an idea of just how bad some of that spending was, and inflation is not helping, especially some of the pressure on the wage front. Then when we look at France, consumer spending, slightly better as we were expecting, came in at 0.2% versus the 0% expectations. GDP slightly better, but PPI, again, still elevated at 1% in December, bringing us to 17.7% in year over year. Services PMI right in line with expectations of 53.1. Same with manufacturing at 55.5, bringing the composite at 52.7. France continues to be a fairly steady as she goes, growth profile. Not extreme growth, but again, still bumping along and seeing some of that expansion, again, providing some of that uplift in the near term. GDP contributions, inventory was negative. We expect that to increase as domestic demand does come down a bit. Again, speaking to the wage issues that we've highlighted. Goods consumer spending, you can see right in this confidence range that we've seen. We do see this coming a bit lower to the bottom, if not falling out of the confidence range. But we do see that is going to have a little bit of a bounce afterwards. But again, a little bit of that carry forward. Spain, again, GDP grew faster than expected, came in at 2% instead of the expected 1.4%. Retail sales still negative, CPI also negative. But then when you look at manufacturing and going forward, manufacturing PMI expected at 56, came in at 56.2. The services side is the concern. Was expected at 51.9, came in at 46.6. Some of that has gotten better, but we do see more contraction, and a lot of that is coming into just what is happening with the wages. So the composite was expected at 52.7, came in at 47.9. So now we're fully in contraction, and there's not going to be enough uplift on the service sector to adjust that, which again is going to be a bit of that concern that we have looking at economic growth as we progress through the remainder of Q1. Spain, real GDP, just giving you an idea of what the GDP looks like. Household consumption still rolling over. Exports gotten a bit better. But when you look at government consumption, again, still trying to support. But investment, household consumption, all deeply negative, all things that are going to remain negative, especially given some of the headwinds that we've talked about on the wage front. Italy, when we look at Italy in general, you can see that on the industrial sales side, better than, continuing to improve. Consumer confidence starting to roll a bit, manufacturing confidence, but again, still in an elevated level, still showing some support. PPI slow to touch to a growth of only 0.9%, but year over year still at 27.8. GDP coming in slightly better at 0.6% versus the estimate of 0.5. But manufacturing PMI did slow. Now, we weren't expecting this size of a slowdown. Expectations were for 61.2, came in at 58.3. We expected expansion. We expected something closer to 60 just based on some of the metrics, but now you're starting to see that cool off a bit. And it's really CPI is just blowing higher. Expected at 4%, came in at 5.3% year over year. Again, it was expected to be negative month over month of negative 0.7%, came in at a positive 2%. And then that again drove services down, expected at 50%, came in at 48.5. And then the composite barely eked out expansion, was expected at 52.3, came in at 50.1. So the services, again, all leading to the problems that we keep talking about on the wage front, inflation front, which is going to continue to be that overhang to some of the investment, some of the increases in manufacturing that we've been discussing. This is just showing how it's showing up. Manufacturing confidence still fixed kind of where things are. That, again, is going to be the positive contributor as the consumer confidence rolled over aggressively. This is happening all over Europe, which is why we continue to be concerned in general. So you get the tailwind of manufacturing, headwind to the consumer, headwind of inflation, which again is going to put the ECB in a tough spot where we do expect a rate increase by the end of this year. And again, some of the things that we're going to be looking at, especially on the inflation and wages front. Now that we've covered Europe, we're going to shift again into back into Asia and talk about some of the things that we're seeing on the Chinese front, as well as some of the ASEAN nations.